Hi, folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we'd come to you today with a brief market update, kind of let you know what's going on out there. S&P 500 had a fantastic day yesterday, up about 3% to about 4,075 for a level. That is up about 14% quarter to date, in what we hope is not a repeat of what happened in the third quarter. For those of you who have memories that stretch back that long, we saw a similar pattern in the third quarter where the S&P 500 was up about 14% before it got sort of end of month inflation data that was a little hotter than we expected it to be, and it gave it all back. Knock on wood, we might be able to hold this gain level if inflation doesn't creep back up again in December, which we'll know here in about 2 weeks. In any event, that 3% market rally was driven predominantly by a speech given by Powell around the state of inflation and the state of interest rates and et cetera. In that speech, he sort of indicated that the Fed might be ready to trim back the pace of rate cuts. For the past 4 meetings, the Fed has raised interest rates by 75 basis points every time they've lifted rates. And Mr. Powell basically indicated that maybe as soon as the December meeting, they would be ready to slow the pace of that increase down to about 50 basis points. So 1/2 of 1% instead of 3/4 of 1%. I would still note that they are not talking about cutting rates or even leaving them flat. They're just talking about slowing down the pace of increases, which is actually something the market had kind of expected going into the speech. There were about 65% odds based on the shape of the forward curve that the December increase would only be about 50 basis points. So a little bit of a relief rally going on yesterday as the market maybe expected 1/2 of 1%, but was fearful that they might not get it. The speech yesterday sort of confirmed that that might be on the way. I would still note also that Powell's commentary was very hawkish in the sense that he indicated that we are a long way away from being done with the inflation fight. That the Fed would plan to leave rates in restrictive territory for longer. And that the conversation was maybe shifting a little bit from how high do rates have to go to slow down the economy. We appear to be seeing that number around these levels and shifting a little bit more towards, okay, well, how long do we have to leave interest rates in restrictive territory before we get inflation down to a level that the Fed feels is acceptable? And once again, I just remind everybody, the Fed is not going to tell you that they are done until they actually are finished. It's not uncommon for them to telegraph maybe a couple days in advance or a couple weeks in advance. They're not going to tell you, months in advance that they think that, it's going to be 3 months or 2 months or 4 months, partly because they don't know, but also partly because if they telegraph that far in advance, then you go ahead and get the relief sooner than they think you need it. I'd also just note that the data that we've seen of late, and I would, 1 or 2 data points is not a trend to make, but the data that we've seen of late has been consistent with gradually slowing inflation, not deflation, not prices actually going down, but gradually slowing of price increases. We got the October PCE price index this morning. It was up about 22 basis points month over month, or about 5% year over year. 5%, while not at the 2% Fed target, is certainly a lot lower than the 7, 8, 9% that we were seeing in previous time periods. So slowing inflation, but still not to where we'd want to be. We also got, of note, the ADP jobs report this week for November. Payrolls were up about 127,000. That was well below the 190,000 estimate, as well as the 239,000 jobs that were created in October. So a little bit of a slowdown in the labor market, or at least a first indication of a little bit of a slowdown in the labor market. And I'll just note again, All of this is consistent with gradually slowing inflation, not deflation, but slowing inflation, and is consistent with what we need to see, but it's very early days. One or two data points does not a trend make. I'll also just comment out there, when the Fed is quiet or when we're not getting data, you'll get some information on, China, COVID, or some of these European things, et cetera. COVID cases going up in China, and China talking about potentially easing restrictions or maybe not easing restrictions depending on the day or who you're reading in the press. I just note that, supply chains are very long. Stuff manufactured in China generally takes at least a couple months, if not, 6 to 9 months to get over here and to be stocked on shelves. And if you ask most retailers right now, they don't want additional goods coming out of Asia. In fact, they'd like to see some of those goods shipped back so that they wouldn't have to discount as much going into Christmas. So all of those comments are really more 6-9 month out in advance type, concerns, not necessarily what's going on in the immediate term to drive the economy. And I also will just note that, goods inflation appears to be not what we're concerned about now so much as services inflation. Services inflation is driven by wages, and thus it tends to be a lot more sticky. So with that, I hope you're having a great week. Really looking forward to a great holiday season. As always, if you have any questions, please reach out to myself or to your advisor. Look forward to talking to you again soon.